Right now, corporate boardrooms are prioritizing generative AI as a primary tool for automating internal tasks and reducing administrative overhead. But an EY report suggests that while these language models improve back-office speed, they mostly refine existing processes, like underwriting drafting and customer service. They don't change the underlying nature of what is being insured. The deeper disruption comes from physical AI. When integrated into autonomous vehicles and humanoid robotics, it moves from the digital cloud into the physical world. For over a century, the insurance industry has relied on a single, predictable anchor for its business model: human error. Motor and workers' compensation policies are priced based on the statistical likelihood of a person making a mistake. When physical AI is introduced, that anchor is pulled up. The human operator is removed from the driver's seat and the warehouse floor, replaced by a system of sensors and code. Because the legal framework for liability is built around human negligence, removing the person leaves a gap in the industry's ability to assign blame. Insurers are now facing a multi-billion-dollar question about who pays when a machine makes a split-second decision. To see the problem, imagine a driverless delivery pod involved in a collision at a rain-slicked city intersection. In a traditional scenario, a human claims adjuster arrives to look at physical evidence, measuring skid marks and interviewing witnesses to see if a driver was distracted or speeding. In this new reality, the physical investigation is secondary to a digital audit. Adjusters must now parse through sensor data and software logs provided by the manufacturer to reconstruct what the vehicle saw. Adjudication moves from evaluating human reflexes to diagnosing software faults. The question isn't whether a driver was tired, but whether a specific line of code failed to distinguish a pedestrian from a shadow. This shift is called System-Centric Liability. Risk is no longer tied to one person, it's distributed across the value chain. Blame could rest with the hardware vendor, software developer, or the fleet owner who missed a critical update. When the responsibility for an accident is fragmented across several multi-billion-dollar tech companies, the traditional claims process becomes paralyzed by a cycle of finger-pointing. To solve this, insurers have to change how they price the risk before the vehicle ever hits the road. A static annual premium is mathematically irrelevant for a vehicle that constantly switches between machine control and human intervention. This illustrates dynamic underwriting, showing how premiums recalibrate in real time. Companies are testing policies that adjust the price the second a car switches into autonomous mode. The risk profile drops, and the policy reflects that instantly. Insurers must stop treating a vehicle as simple property and start pricing it as a living entity that makes its own safety decisions. But the risk doesn't stop at the vehicle's edge. We have to look at the macro environment that allows these autonomous fleets to operate. Physical AI is entirely dependent on external factors, specifically constant data connectivity and a stable power grid. This creates a new set of physical assets that require insurance, widespread charging networks, and the smart sensors embedded directly into the roads. Then there is the digital infrastructure. Massive data centers serve as the centralized brains for these systems, processing navigation and safety protocols for entire fleets. This creates a terrifying cascade effect. A single failure at a regional data center could simultaneously disable or crash thousands of vehicles across a city, creating a scale of loss that the industry isn't yet structured to handle. Physical AI shifts the insurance burden from individual driver behavior to the reliability of a city's power and data networks. The industry is moving away from a model of personal accidents and toward a model of systemic infrastructure failure. Ernst & Young issued a stark warning. The intense focus on generative algorithms is blinding insurance firms to a much larger existential threat. This flowchart shows generative AI acting as an operational optimizer, smoothing out internal workflows like underwriting and customer service. But physical AI, like autonomous vehicles and robotics, shatters that linear process entirely. It attacks the core business model by invalidating the traditional structure of liability. Autonomous technologies force a total rewiring of how risk is defined and exactly who is responsible for holding it. Optimizing an internal operational pipeline is a fatal distraction if the underlying liability structure that pipeline relies on has already collapsed. This diagram represents the baseline assumption of traditional property and casualty and workers' compensation insurance. A single identifiable human operator sits at the center of the risk model. Physical AI splinters that singular point of failure into a complex supply chain. distributing risk across hardware vendors, software platforms, fleet owners, and the end user. For traditional motor and workers' compensation models, this presents an immediate logistical nightmare. When an incident occurs, fault bounces erratically between these new nodes. The industry is moving to a system-centric reality. The insured entity is no longer an individual driver or worker, but an entire integrated technological supply chain. This creates the problem of pricing a policy when liability fluctuates from a hidden software bug to a hardware sensor failure to sudden human intervention. Historical human behavioral data, the bedrock of traditional actuarial science, is mathematically useless for modeling risk in a decentralized network. This graph shows a standard 12-month premium. A static annual risk assessment fails completely when applied to systems whose operational states change by the second. To survive, underwriting must pivot toward dynamic, real-time recalibration of risk pricing. Insurers like Lemonade are already experimenting with usage-based policies designed specifically to adjust to autonomous technologies in the field. The mechanism requires pricing to instantly spike or plummet the exact moment a vehicle shifts between human-driven and autonomous modes. Architecturally, this demands a continuous, unbroken stream of telemetry data flowing directly from the physical asset back to the underwriter. The nature of an insurance policy is transforming from a static annual legal contract into a continuous, real-time software subscription. In the immediate aftermath of a complex autonomous collision, the traditional physical claims investigation process fails almost instantly. Photographing bent chassis metal or measuring skid marks on asphalt provides zero utility in determining fault in a system-operated vehicle. This split screen illustrates the logic of data-driven claims. Adjudication moves away from the physical wreckage on the left, relying entirely on the digital telemetry on the right. The required inputs are now hardware sensor logs, internal OEM software records, and system state diagnostics isolated to the exact millisecond of impact. The core competency of a claims department must shift away from appraising physical damage and toward evaluating complex software faults. In the era of physical AI, a vehicle collision isn't treated as a mechanical failure to be appraised, it's a software bug to be debugged. The physical asset itself is only one part of the equation. Autonomous systems rely on a massive, unseen environment to function safely. Because physical AI cannot operate in a vacuum, it introduces an entirely new category of infrastructure risks that must be insured. The liability chain expands outward, capturing critical external dependencies like smart roads, charging networks, and edge data centers. A momentary failure or latency spike in this external infrastructure instantly transfers massive liability back onto the autonomous system's performance. To ensure one autonomous machine, actuaries must now model the risk of the surrounding digital and physical ecosystem, vastly expanding the perimeter of insurable risk. The insurance industry is completing a transition from historical, human-centric risk to dynamic, systemic liability. This dashboard represents the new architectural blueprint required for a modern insurer to survive. Navigating the physical AI boom requires the total abandonment of legacy, static actuarial tables. This leaves a lingering question for commercial lines. How do you completely restructure a workers' compensation policy when the worker on the floor is a semi-autonomous system? Physical AI creates an entirely new environment that insurers must adapt to or face irrelevance.